Good morning. Welcome to the Open here on BNN Bloomberg. I'm Roger Peterson in for Andrew Bell. Now let's get to some of the stories we're following in the BNN Bloomberg newsroom. Oil prices are surging. They're at their highest level in more than 4 years as traffic in the Strait of Hormuz has come to a halt amid the escalating conflict in the Middle East. The Strait, which handles as much as 20% of the world's oil shipments, now at a standstill. Some experts say a halt lasting more than 25 days could cause storage tanks to fill in the region, forcing a cut in production. Toronto-based mining company Hudbay has signed a deal to acquire Arizona Sonoran Copper. The all-stock transaction is valued at a little less than $1.5 billion US, and we'll see Hudbay pay about $9.35 Canadian per share. Hudbay already owns a near 10% stake in the copper mining company. The deal brings its Cactus project together with its existing Arizona business, including its Copper World project. The deal is expected to be completed in the second quarter. Canadian energy firm Cameco has signed a $2.6 billion deal with India to supply the country with uranium. The agreement comes during Prime Minister Mark Carney's first visit to India, where he is trying to build stronger economic and diplomatic ties. Cameco will supply 11,000 tons of reactor fuel to India from 2027 through 2035. And taking a look at the markets, no surprise right now, they are down in the futures. The Dow off by 1.1, the NASDAQ off by 1.55, and the S&P 500 down by about 1.2. And the TSX it is so what it did on Friday there. Yeah, it had a really good week and then just finished a little off, about half a point on Friday. We'll see how it responds when it opens in about a half hour from now. Oil is the one to keep an eye on right now, of course, and it is up, surging right now, up more than 7.6%. It's at 72.10 with all the concerns about what is unfolding in the Middle East. And gold, people heading to a safe haven, up nearly 3% right now, over 5,400, as people follow what is unfolding in Iran. And the Canadian dollar, it is off 0.34% right now. The American dollar has been strengthening today on everything unfolding in the Middle East. U.S. President Donald Trump says the attack against Iran could last weeks. So how is oil responding? We saw some of the numbers, but let's bring Lyle Stein in, president of Forvest Global Wealth Management, to chat more about this. Lyle, thanks very much for joining us. Is this what we'd expect with oil? Is it in the ballpark of a reaction to this?
Oh, yeah. I mean, oil was trading at the $60 level, Roger. And then I think the market kind of got a whiff that there could be some geopolitical dislocation. And it slowly started to drift up. I think, mid-70s makes sense. Whether it's Brent, which is obviously trades higher than West Texas, or West Texas, I think this makes sense. And now it's just a question of what goes on over the next week or so. Again, you mentioned the inventories and blocking of storage, and what does that really mean as the Straits of Hormuz probably won't be opened? So we just have to wait and see. Is it a 2-week war, or will it extend into something else?
Are there a couple of realistic scenarios we could look at for this, or is it really just up in the air right now?
To try to make a bet on this is way beyond my expertise. I think, the notion was, and again, what we looked at oil, at $60 oil, there wasn't as much an incentive for production to come on stream as it might otherwise be. Now with oil at 70, and obviously you've got Iran maybe coming off, or some of that north of the Strait of Hormuz oil coming off, it could go higher. But I mean, there's a lot of oil in the world. It's just a question of getting it to the markets. And what are the politics involved in getting it to the market? Is it Russian oil? Is it Iranian oil? Is it Venezuelan oil? There's a lot of oil. It's just we've had tight markets because of all the politics.
And if this threat drags on and the closure continues, where will people look? I mean, what other options are there? Would they ease up on Russia? Is there any possibility of that? Can Canada benefit from this?
Well, if we had pipeline capacity, we'd be in a much better position. The good news is we do have the TMX taking our oil to port. Yeah, I think that's a really good question. Will Russian oil be allowed to go? I don't think so. Will people go into Venezuela and start pumping? Well, that takes time and capital. So, the OPEC made an announcement that we will increase our OPEC. We will increase production. That's good, but they still have to get it to port, and there are pipelines. But the Strait of Hormuz, I think, ships something like 20% of cross-border oil.
And I mean, I guess longer term, we shouldn't see any impact yet on prices, but there is if this drags on, we'll see prices go up. Then that inflation becomes a concern, doesn't it?
Well, yeah, exactly. Financial people love to talk about inflation X food and energy, but the real person out there is hurting. The real person out there knows what the price of oil is, and more importantly, the price of gasoline. And they benefited as oil stayed in the 60s for the last few months. As prices now go up, the gas pump gets more expensive, and your ability to stretch your budget is hurt because incomes aren't going up. That's the other side of the economy. This could cause a growth slowdown. And the growth slowdown will unfortunately hit workers and workers' pocketbooks.
And going a little beyond, let's talk a little bit about U.S. yields. You're seeing them crack 4%?
Well, it's interesting. That to us is the barrier. Will yields go below 4% on the U.S. Treasury, which is the benchmark around you really want to basically make all your investment decisions? They had held above 4%. They had held above 4% just late last week. They cracked 4%, but they're up again today, over 4%. And, the interesting thing is, as you mentioned, the U.S. dollar is a safe haven, but the Treasury bond is also a safe haven, and it's not behaving in a safe haven manner. Part of that, I think, is because governments are borrowing so much, and the cost of money, the real cost of interest, remains high, and it's going higher.
So does that mean then that gold remains a safe haven, or the dollar? Will people put it into the dollar?
Well, today is unusual. Gold is up and the U.S. dollar is up. Typically, they run the other direction. When one goes up, the other goes down. But gold is the ultimate safe haven, and I think investors are increasingly becoming aware that gold is a place to have your assets. Simply like central banks are buying gold. And so as a diversifier, it's worked really, really well. And frankly, as money flows between sectors, between asset classes, gold is getting the benefit of that. The amount of gold in the world relative to the amount of equities and debt is still quite small. And so you're seeing a bit of a rotation into gold as a safe haven asset.
All right. And then how are the markets going to, I mean, we're seeing in the futures right now, over the next few days, how do you see the markets responding to everything that's unfolding?
Well, I wish I could be so good on that one, Roger. I think we're going to continue to see this rotation, the rotation out of the great stocks of the last 3 years where the AI plays, and they got to be just a really, really large component of portfolios that people hold. And so as money is moving out of that, it's going elsewhere. It's going into hard assets. It's going into energy. It's going into gold and gold stocks. And I think that rotation continues. Through this piece, the S&P 500 really hasn't fallen much. It's only off, maybe 4 or 5% from the top. But individual stocks are going up and down 10, 20%. We saw software get destroyed over the last few weeks. We've seen the AI stocks come under significant pressure. Money is rotating out of those names into more traditionally safe names.
And I'm not sure, I don't think I missed pipelines is one of them. And you're liking that right now, aren't you?
Yeah, pipelines are a great place to be. They're hard assets and they pay, on average, I think we've got pretty much every pipeline in client portfolios here. And the average yield is somewhere between 4 and 5% in total, which is better than what you get on a bond. And they can grow those dividends. And they're relatively immune from all the geopolitical concerns. In fact, one might say they could benefit as they move energy to markets that need it.
Okay, we'll wrap it up there. Lal, thanks very much for joining us.
Hey, have a good week.
Cheers, you too. Lal Stein is president of Forvest Global Wealth Management. Coming up, we'll look at how the attack on Iran is stoking geopolitical tensions in the region. That's after the break. It has been a tense weekend for the world after the U.S. and Israel launched military action against Iran after nuclear armament talks ended with no deal in sight. U.S. President Donald Trump warns that the U.S. could see more casualties before Operation Epic Fury comes to an end, which he says could go on now for weeks. For more on this, we're joined by CTV's Scott Hurst. Scott, thanks for joining us. What's the latest out of Washington, and are we hearing from Ottawa?
Roger, good morning. Strikes across the Middle East continue to intensify. Just recently, we heard from U.S. Secretary of War Pete Hegseth outlining some of the U.S. goals to this operation, which launched on the weekend, bluntly saying the goal is to destroy Iran's missile capabilities, destroy its navy, and destroy its ability to ever have a nuclear weapon. He went on to say that they've launched hundreds of missions and that the U.S. continues to send additional troops to the Middle East, as this operation has sent shockwaves politically, economically, and militarily right around the world, as the United States and Israel are pressing ahead in their joint campaign, while Tehran has launched counterstrikes of its own, vowing revenge for the death of Supreme Leader Ayatollah Ali Khamenei. But as the bombardment continues, Roger, the conflict is widening beyond the U.S., Israel, and Iran, with the hostilities expanding on multiple fronts, with Iran-supported militant groups, including Hezbollah in Lebanon, firing missiles at Israel. In terms, as you mentioned, a response from Ottawa, we did just recently this morning hear from Foreign Affairs Minister Anita Anand, who said, first and foremost, that Canada was not notified of this operation before it went ahead early hours of Saturday morning, and said that Canada has not and will not be involved in any military operation. A joint statement from the Foreign Affairs Minister and the Prime Minister states that Canada does support the United States acting to prevent Iran from obtaining a nuclear weapon and to prevent its regime from further threatening international peace and security. However, what we heard from the Foreign Affairs Minister this morning is that Canada is pushing for a more diplomatic solution to this operation, Roger, that was launched on the weekend, and as you mentioned, will likely continue, according to the U.S., for several more weeks.
A couple of quick questions. The first one I want to ask, you mentioned about troops, more troops have been brought to the region. Now, Trump has said they don't see any kind of a ground war happening. Are these all just military personnel to help with the air war?
At this point, that appears to be the positioning of the U.S. military. There is no immediate plans that they've released in terms of boots on the ground in Iran. So right now, the targeted operation continues, with more being brought into the region. It appears to be in a supporting capacity right now.
And with that retaliation that we saw from Iran, has that lessened a little bit since the first round on Saturday, excuse me? And what kind of reaction are we seeing from the countries in that region?
Well, Roger, we're continuing to see a lot of reaction from countries in the region, and also a lot of caution from countries in the region. As we mentioned, not just retaliation from Iran for revenge and retribution for killing its supreme leader, but also the Iran-backed militant groups are also, they're also claiming that they're providing counterstrikes as well. So, it is providing for a lot of tense moments, not just between Iran, the U.S., and Israel, but many other actors, many other different countries and also allies in the region, Roger.
Okay, Scott, thanks very much for that update.
Thanks, Roger.
Scott Hurst from CTV News. Now, U.S. President Trump announced the attack on Iran over the weekend, moving oil prices. Here to talk about the U.S., Israel, and Iran geopolitical tensions that, of course, are driving those oil prices higher is John Allen, former ambassador for Canada to Israel and a senior fellow of the Bill Graham Center for Contemporary International History at the University of Toronto. And John, thanks as always for joining us.
My pleasure.
What led to this latest? I mean, we saw them launch an attack 6 months ago. It felt like things had calmed down. What built this one up?
I think a combination of factors. One was the weakness of Iran and the weakness of its proxies in the region. Obviously, Hamas had been weakened. Hezbollah had been seriously weakened. The Houthis had backed off once the ceasefire in Gaza took place. And Iran's ballistic missile defenses had been seriously harmed. I guess the other thing is that I think Bibi Netanyahu was able to convince Donald Trump that this might be an opportune time either to negotiate the end of Iran's nuclear capabilities, or if that doesn't work, to try and force a regime change or a change in policy regarding nuclear ballistic missile technology and support for proxies.
Now, we saw the leader taken out and several key figures in the government. What does the new Iran look like right now? That new the government that is on the ground there, is it one that would be open to some kind of a deal, a peace deal?
The new looks very much like the old. They have the same president who is reported to be more a liberal. They have now former Supreme Court justice who is considered to be very hard line. And they have another cleric taking the place of Khomeini. So far, Iran has said they're not interested in opening up negotiations again. They were in the middle of talks when Israel and the U.S. began the bombings. President Trump has indicated that he would be open to having renewed discussions. But I think at this point, Iran is a bit wary of trusting either Trump or Netanyahu.
And now Trump called for the people of Iran to rise up. Is that realistic? And what might happen if that actually did happen?
I don't think it's realistic. He suggested that the Iranian Revolutionary Guard lay down their arms, they would be given immunity, and they should hand over their weapons. Now, who should they hand over their weapons to? Very recently, in January, approximately 30,000, according to some reports, of Iranian citizens who were protesting were brutally massacred by this same Iranian Revolutionary Guard that Trump is suggesting should lay down their arms. And I don't think they're ready to do that right now. And it's not at all clear, unless there are boots on the ground, who they're going to hand their weapons over to. I think while the Iranian people in Iran and in the diaspora are welcoming the attacks, at the same time, they're very worried about where this could go. As we know, Roger, regime change in the region, in Afghanistan, in Iraq, in Yemen, and Libya has not gone particularly well before.
And I just want to get your thoughts on, we're almost out of time, but Mark Carney's release on this, his statement. Thoughts on that, and where does Canada fit in with all this?
Well, I must say I was a little surprised with how full-throated the Prime Minister's support for these attacks were. In my opinion, and I think in the opinion of some others, this was not a case in which there was either the right of self-defense. There did not seem to be an imminent threat against either the U.S. or against Israel, and there was no UN Security Council authorization. So it's certainly arguable that these attacks were contrary to the UN Charter and customary law, which talks about the non-viability of states, and there are very limited reasons for conducting these attacks. So Carney, nonetheless, and despite what he had to say in Davos about opposing might is right, came out very clearly, much less nuanced than his European partners, and said that he supported this fully. Obviously, he supports the security and of Israel and its right to exist, and he talked about, obviously, the various horrible things that this regime has done and has threatened in the past. There's no question about that. But whether or not you want to give Donald Trump and Prime Minister Netanyahu the right to decide who to attack when, I think is another issue.
Okay. John, we have to wrap it up there, but always appreciate your insight on this. Thank you for joining us.
Thanks very much.
John Allen is a senior fellow of the Bill Graham Center for Contemporary International History at the University of Toronto. Up next, from airlines to defense stocks, we'll look at some of those being affected by the Mideast tensions. All right, let's take a look at the U.S. futures as we count down to the opening bells. And it is an interesting day that lays ahead. You can see the market's kind of predicting that right now. The Dow off by 1.17, the NASDAQ now off by 1.55, and the S&P 500 down by 1.2. And it's a mixed bag right now. We're actually seeing some stocks rising, not surprisingly. Defense stocks, which have already rallied over the past year, with everything that has been going on with the global tensions, with that attack on Iran 6 months ago and everything else that has unfolded around the globe, they have been rallying. Take a look. Lockheed Martin right now is up 5.6%. And one Stifel analyst, Jonathan Siegman, said in his Monday note to clients, defense spending was already set to surge in 2026, and a protracted war with Iran will make the spending more urgent and less controversial. And you're seeing that right now. Going the other way, though, is airlines. They are feeling the pressures, and cruise lines. But the airlines taking a look here at how they are responding right now. Delta is off by 5.8. Of course, a lot of the airspace over the Middle East now is off limits. No flights getting in and out throughout that area. It's also a key crossover area, too. So flights now have to start going around countries, which ends up raising costs. And we're seeing the airlines off. Delta down by nearly 6% right now. And another group taking a hit right now, the cruise lines, the operators like Carnival Cruise Lines, they are taking a Carnival, look at that, off by 8.6. The concern there, of course, reduced travel. People have fears of what might be targets, but also oil prices rising. They spend a lot on fuel costs, same with the airlines, and so that could be putting a lot of pressure on them. Carnival, as I mentioned, is off by 8.6, and also Royal Caribbean is down as well. Norwegian as well. They are all feeling the effects for today as we watch the situation unfold in Iran, where we have heard from the president that this may continue for weeks. So we'll have to see what happens with the situation there. Coming up next, the opening bells. All right, taking a look at the opening bells of the NASDAQ. Axogen is ringing the opening bell. It produces and distributes medical and surgical instruments. The New York Stock Exchange, the Atlanta World Cup host committee gets to ring the bell there. And of course, the World Cup coming to North America. Toronto and Vancouver will be hosting some of those games as well, starting in June. And at the TSX, it's the TSX North American Mining opening the markets in celebration of the Prospectors and Developers Association of Canada, PDAC, 2026 convention, which is getting underway now here in Toronto. And Andrew Bell is at the convention, and we'll have more for us in the next hour. Time now for the first 15. This is BNN Bloomberg. Trading is just getting underway. And let's check in on the equity markets. No surprise, they were down in the futures all morning. And that's where they're staying right now. TSX off by about a half point. S&P 500 down by 1. And the NASDAQ off by 1.3% with that instability and the attacks on Iran shaking the markets right now. And taking a look at some of the movers, the first 15 movers, let's head up, stay in Canada first. Suncor in the green. Nice to see that. It's up 3% to start the day. And one we'll be keeping an eye on. This is going to have an impact. I mean, Suncor Energies is going to have an impact. The oil price is surging right now. Going the other way, though, a lot of the airlines. Let's see what Air Canada is doing as we start the day. Not surprising, it is off by 4.8%. Of course, the big concern. Flights get canceled, but also rising fuel costs, such a key factor for the airlines. And so we'll see what happens with that through the day. But it's Air Canada is off by about 5% right now. South of the border, it's defense stocks that are seeing a surge. Look at Lockheed Martin, up 5%. It's been going gangbusters for the last while anyways. And then, of course, this just sealing in all the global tensions we've seen in the Middle East over the last year or so. And investors are looking for more success there with Lockheed Martin. It is up 5%. As we mentioned, airlines in Canada under pressure, and airlines south of the border also feeling the same way. Delta, as the market opens, it's off 4.6%. Again, that concern about fuel, rising fuel prices, so critical for the airlines. Also, but flights being canceled, flights having to reroute, take longer routes to go around no-fly areas, which essentially is most of the Middle East right now. And so those airlines are doing a lot of work right now figuring out what their next move is. And also feeling the effects of this in the negative are the cruise lines. And Carnival is off by 10%. Again, oil is such a key thing for them. They need to move those big ships, move them around. It takes a lot of fuel to move them. But also people get worried about traveling and about going on ships and cruise ships. So with the being vulnerable, potential for any kind of response or terrorist attacks, things like that, has people questioning taking vacations right now, and that's what people are reacting to right now. Carnival off by nearly 10%. And of course, all this is on the oil surging the most in 4 years because tanker traffic halted through the Straits of Hormuz and the escalating conflict in the Middle East. All of that threatening supplies. Here to talk about this and the morning's markets, Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. Andrew, thank you as always for joining us. Let's start with oil. It's going pretty much where everybody expected it to go today, it seems.
Yeah, pleasure being here, Roger. This is, a different risk than we saw with Venezuela, Roger. Analysts are looking at this as being a more protracted affair with respect to Iran. And now what we're seeing is a spreading out across the Middle East, which is obviously going to have a positive impact for the price of oil. Some analysts, as you've mentioned this morning, looking at the potential for crude to get to $100 a barrel. Obviously, there's nobody out there that can rule that out, especially if this conflict continues for a week or 4 weeks, as Trump has alluded to.
And I imagine, Iran makes up, I think, about 5% of world oil, but it's the Strait that is the big thing, isn't it? Keeping that open.
Exactly. It's the Strait. It's where we see the passage of a fifth of the world's oil production in terms of supply distribution. It's not just Iran. So we're seeing that directly on the impact on crude. We're also seeing it with respect to, for example, gas prices in Europe, because, again, a lot of your LNG production is in that region. And two of those suppliers have basically had to shut down amidst the conflict and the threat levels in that region. So it's going to hit crude, it's going to hit nat gas, I think, as we worked our way through this.
Yeah, did I not see Norwegian nat gas was just jumping?
This morning we saw a 45% spike in that price. So, that just tells you the sensitivity of supply in Europe to production in the Middle East. It's no longer just an Iranian oil production issue. It's now refineries and, again, tanker shipments through the Strait.
And the President Trump has said this could go on. There could be more. There will be more attacks. It could go on for weeks, maybe less. It all depends on, I guess, what happens with Iran itself, the new government. How long can this kind of go before it's already worrisome, but then it really gets worrisome?
Well, I think a lot of this will depend on how strong Congress wants to be in the face of this. Because, again, keep in mind, we're dealing with the midterm election year in the States. Affordability has been one of the key themes going into these elections. Well, if oil is going to go to $100 a barrel, we kind of know what's going to happen to gasoline prices in the States. And therefore, we're going to go backwards on affordability. So it'll be interesting to see how much more back pressure Congress applies. Again, coming back to the affordability issue, Roger, we've been talking about, can the U.S. reaccelerate in terms of the economy? Can we see this in a low inflation environment? Can interest rates decline further? Well, a lot of that gets thrown out the window if we're talking about a 4-week affair where now the inflation outlook is going to be completely up in the air. And again, we could see inflation coming back. So this has repercussions beyond what we're just seeing in the markets today. I would argue it has repercussions in terms of what we see the consumer doing this year and what happens to the overall level of inflation.
And you feel this could push the U.S. into recession?
I think the probabilities will go up. If we're at this for 4 weeks, Roger, if you and I are talking about this at the end of March, with oil prices up where some analysts think that we could see, I think it would be naive to think that the U.S. economy could just shrug this off. Interesting thing to keep in mind, before we came into the weekend, we were talking about something called AI and what impact that may have on labor markets and ultimately consumption. That was before we even got into this. So now you're just kind of layering a risk on top of that. So yeah, I think the probability of a setback in the economy moves higher the longer we're at this.
And then what about Canada relative to that?
Well, Canada is not going to be immune from this. Obviously, we're talking about it this morning, Roger, in terms of airlines, in terms of travel. We're sensitive still to what happens in the U.S. economy. So we don't get away with this with no impact. But I would argue, and we're going to see this in the markets this morning, that the TSX is going to have more resilience than the markets in the States, simply because we still have a very strong energy sector and a well-capitalized financial sector. I think that ultimately keeps the Canadian equity story, above what we're seeing in the States in terms of where do we want to be positioned.
And where do you go with this? You're looking at all this. What are you doing right now? Who are you looking at?
Well, right now we're looking at the energy sector in terms of where we want to be, especially in Canada. I mean, one thing to keep in mind when we talk about oil supply, those producers that have a high degree of sensitivity to that region in terms of getting output out of that region are going to benefit from higher prices, but they're also going to be disenfranchised by weaker volumes. Compare that to Canada, Roger, where we've got a lot of our energy producers really are not wedded to what is happening in the Straits. We do ship oil by pipeline, and we can ship oil from either side of the country. So I think the Canadian energy patch is where we're focused on right now, where we want to have that exposure. And I think ultimately for the economy itself, unless this becomes a protracted affair that drags down global economic growth, Roger, to the point where it does hit Canada, we're still comfortable here.
Yeah. And CNQ is one of the ones you're liking right now.
CNQ, I think, is one of those Fort Knox stories for Canada in terms of the energy patch. It will benefit from higher prices for crude. It doesn't have the same sensitivity to shipments through that region. A lot of its production, Western Canada, the North Sea, which is one of the reasons we like the stock. And of course, it pays a handsome dividend.
All right. And looking the other way, this is just, we're pulling in a stock you're not liking so much right now, Western Union.
Yeah, again, getting back to my earlier comment, the AI story has not gone away just because the U.S. attacked Iran over the weekend. That displacement thesis of companies that ultimately are going to be, negatively impacted by the usage of AI, whether it's mid-level software companies, Roger, or in the case of Western Union, a company that really has benefited from this ease of transfer of money, which now is going to be facing competition from other firms in the financial sector that now can use AI tools to generate that transfer of money more efficiently. So I think we're going to see some margin compression with respect to Western Union. So it's a stock that we don't think really we want in the portfolio today.
Now, are they not, I assume they were looking at AI. Would they not be starting to implement it as well, though? And because they do this for a living, staying ahead of anybody else?
Oh, absolutely. They have no choice but to do it. The question now becomes firms out there that can deploy more capital, relatively more capital to these technologies and benefit from that. And I think that's ultimately where Western Union probably is not going to stand up as well against some of the larger titans in the financial sector, whether it's the States or globally.
I wonder if they'll have to go back to ponies, riding the ponies.
They might have to.
All right, Andrew, thank you as always for joining us.
Thank you, Roger. Pleasure.
Andrew Pyle is a senior investment advisor and portfolio manager at CIBC Wood Gundy. Coming up, Jeff Curry, Chief Strategy Officer of Energy Pathways at the Carlyle Group, says the risks to energy supply chains have never been higher, and it's not the places you might think. Jeff Curry, Chief Strategy Officer of Energy Pathways at Carlyle, says the impact of escalating conflicts in the Middle East are increasing risks to the upside. We got perspective with him in a Bloomberg interview. Have a listen.
I think the probability of regime change is somewhere around 30%, which means the base case is this thing's going to be a protracted experience. In terms of thinking about what this means in terms of the risk, is let's go back to the Iranian asymmetric doctrine. It means proxies. And this focus on disruptions in the Hormuz Strait, I think, are misplaced. Yes, we're going to lose supplies there. I'm not going to say that's not going to happen. It could be 100 million barrels plus, which is the size of that oil supply gut at sea, which, we've been dismissing for the last 18 months. But I think the real risk is we're going to see proxies in other places. You have, I think, the Abraham Lincoln sitting in the Gulf, the Ford is in the Eastern Med, and the Houthis are in the Red Sea, but nobody's guarding places like Mozambique LNG or other choke points around the world. And I think Iraq is another one you got to watch really carefully, and that's the second biggest member of OPEC. So I think, the risk here this is a protracted environment, and that, the risks are to the upside. One last point here is we've been talking about a security premium in energy prices now for over a year. I think this is it. This is going to be a structural repricing, and, I would not fade this current spike.
But, Jeff, so just so I fully understand, this would be basically Iran and proxies going after energy infrastructure to almost on purposely put the price of oil up so that Trump backs down?
I'm not going to go. That could be part of it. I think there's a bigger point here, is that the risk of your supply chains right now have never been higher. And if you're China, you're India, you're going to start to hoard oil. And not only oil, but all commodities. I think I was on here 2 or 3 months ago, banging the drum on hoarding. The hoarding situation is going to become more extreme. So that increases the demand for oil. At the same time, you look at supply. Yes, OPEC announced a 200,000 barrel per day increase, but you look at past compliance, that's 80 to 90,000 barrels per day. Less than half, because we're capacity constrained outside of Saudi Arabia and UAE. But
what do you think is needed for the Strait of Hormuz to normalize? And actually, you don't think that will really normalize over the medium term?
You look at why we think you could get disruption in this, I'm going to say this first kinetic storm, is because it's like a hurricane. You're shutting down the rigs, you're evacuating crews, the ships are being moored just like it were a hurricane. That's going to last for probably 7 to 10 days. Once we pass that, this current kinetic storm will probably subside. But the overall situation, we don't know where it's going to hit next. I guess it goes back to this whole idea of Iran's, asymmetric doctrine. It could be anywhere.
So how much do you think will be lost? I mean, is it impossible to quantify how much supply could be lost?
Okay, let's just go through the math. Let's say there's 20 million barrels per day that go through the straits. You have pipelines through Saudi Arabia and through the UAE that could take out another 6.5 million barrels per day. You have inventories and things of that nature. So let's put it at, let's say, 8 to 10 million barrels per day. Do that for 7 to 10 days, you get 100 million barrels per day plus. Let's say that's the same size as that floating glut that was sitting in like the South China Sea. So it's kind of a wash. But then what happens after that? That's the point here. Yeah, I would be careful fading it because it starts to become much more serious. One last point is, let's not forget, the reason why people were not reading that oil supply glut correctly is because we have 2 supply chains in the world, U.S. block and China block. You need more inventory for a bigger supply chain. And what ships are getting through the straits right now? Russian, Chinese, and Iranian. So the China block is still flowing oil through the straits.
That was Jeff Curry, Chief Strategy Officer of Energy Pathways at Carlyle. Well, Friday on Market Call, we were joined by Brian Madden. He's an investment officer at First Avenue Investment Counsel. He was covering North American equities, and his top picks were MBA Space, Home Depot, the TMX Group. And today on the show, we have John O'Connell. He is CEO at Davis Maria, and we'll be taking your questions on North American large caps. Just ahead, we'll put the spotlight back on the airlines as their shares come under pressure this morning. Travel chaos in the Middle East and beyond, sending airline stocks sharply lower as the fallout from the U.S.-Israel-Iran conflict widened. Carriers across the Persian Gulf extended blanket flight suspensions, causing major disruptions at some of the world's busiest airports. Bloomberg's Lean Al-Rashdan reports from Dubai.
We have the UAE, Qatar, Kuwait, and Bahrain have all closed their airspace. Iran and Israel, obviously. These are massive disruptions at a scale unseen before. You have airports that are some of the busiest hubs in the world, the biggest international airlines halting operations. Some of the airports have been struck. They've all been evacuated, and airlines are extending the cancellations. It doesn't seem there's an end in sight, and there are thousands of people stranded, thousands of flights that have been canceled, and this is rippling through the industry. You can see Lufthansa's down this morning, Cathay, Singapore. This is going to have ripple effects over globally.
So, Lean, what will be the aftermath of the disruption?
I mean, even if airspace is open, the airports are still, they have damages. The airlines have to evacuate people who are still in the country. I mean, they have to repatriate, they have to bring back passengers who are stranded abroad. They have to bring back their carriers. I mean, most of the Emirates Airbus A380s are not even in Dubai. So we're talking about disruptions that are going to last for at least a few weeks, and the financial impact is going to be very large. If you look back at when the floods happened with Emirates, they lost about $100 million, and that was on a much smaller scale. So there's going to be hundred millions of dollars in impact.
Well, top Wall Street strategists have been busy updating their market calls given the Iran conflict. BNN Bloomberg contributor John Ehrlichman joins us now with, when we come back, actually, John will join us for that. Top Wall Street strategists have been busy updating their market calls given the Iran conflict. BNN Bloomberg contributor John Ehrlichman joins us now with more on the message from the market pros. John, imagine we've been getting some mixed messages and people trying to figure out what to say, eh?
I think that's absolutely the case, Roger. You're right, because given the state of where the markets have been heading into this conflict, you would have expected some strategists might be willing to take a bearish tone. I found that overall, some of the largest firms with their notes this morning have been quite bullish, but you're right. They've put all sorts of caveats in their call. But I think it's because a lot of them are looking at what has happened in history with major market shocks and how the market oftentimes bounces back. JP Morgan, just as an example, put out a note to clients and they said, if you're an investor with a 3 to 12 month time horizon, they'd still be invested in the market. They're just buckling up their seatbelt for the time being. And obviously, you've been talking a lot about this morning, the fact that people gravitated towards gold. The caveat, it seems more than anything, and I know you've been talking about this, is what ultimately happens in terms of how long the conflict goes on for and what it means for the price of oil. I found Citigroup, Goldman Sachs, Morgan Stanley, their biggest caveat seemed to be if there was the possibility that oil prices were to push through $100. There's a lot of commentary right now on, the situations in the past, such as 2022. Goldman Sachs talking about when oil was at $120 and how that impacts different industries. Before the break, you were talking about the airline industry. But if we do see a short-term resolution to all of this, obviously a big wild card, generally I found a lot of the strategists at the top firms to be somewhat bullish this morning.
And I mean, it really is tough to base your decisions on history because, we watched the first attack on Iran. We thought everybody would be coming in and the markets would be madness, but it wasn't really. Nobody even flinched in Venezuela. So how do you even predict?
Yeah, I mean, I always like the historical data number crunching that some firms do. Carson Group does a really good job of it, actually, and they put out a note highlighting more than 40 examples of market shocks, geopolitical events, major historical events going all the way back to 1940. And what they found is with the S&P 500, if you go out 6 months, more than 60% of the time, the market ended up being higher. And on average, it was up more than 3%. Now, to your point, there's already some other firms like RBC that are saying you can't just sort of take the historical, sort of the entire pie. But I think that will be very interesting to watch for sure.
Because, I mean, it really, I know we hate to say this in cliche, but it does feel like a different time. I don't think we've ever seen a president like Donald Trump and his impact on the markets.
Yeah. And I think the question will be if investors are willing to do some buying, what are they willing to buy? Like Morgan Stanley this morning said, we'd still be leaning towards defensive stuff that has good valuations. They like U.S. healthcare because literally last week we were still in this conversation around should you buy the biggest tech companies after the run they've had? Should you buy tech companies that are disrupted by AI? So there's all these factors out there.
All right, John, we got to wrap it up there, but thanks as always for joining us.
Thanks, Roger.
BNN Bloomberg contributor John Ehrlichman. And just ahead, we'll look at what the pickup in volatility means for long-term risk with David Rosenberg, President and Chief Economist and Strategist at Rosenberg Research and Associates. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Well, the price of oil is surging. It is up nearly 6% right now as tanker traffic comes to a stop in the Straits of Hormuz following the U.S.-Israeli attack on Iran. Saudi Aramco has also halted operations after a drone strike in the area. The escalating conflict is threatening supplies in one of the world's key oil-producing regions, with the Strait handling as much as 20% of the world's oil shipments. U.S. President Donald Trump has said combat operations will continue until all U.S. objectives have been met. Shares of Hudbay Minerals seeing a decline, off by 7.4% right now. A Toronto-based miner has signed a deal to acquire Arizona Sonoran Copper. The all-stock transaction is valued at just under $1.5 billion US, and we'll see Hudbay pay about $9.35 Canadian per share. Hudbay already owns a 10% stake, nearly 10%, in the copper mining company. The deal brings its Cactus project together with its existing Arizona business, including its Copper World project. Canadian energy firm Cameco has signed a $2.6 billion deal with India to supply the country with uranium. The agreement comes during Prime Minister Mark Carney's first visit to India, where he is seeking to build stronger economic and diplomatic ties. Cameco will supply more than 11,000 tons of reactor fuel to India starting in 2027, running through 2035. And taking a look at the markets right now, the TSX is off, not too bad. It's off by about 0.3% roughly. Airlines taking a hit today. Anything travel related with the fears oil prices could surge. Oil companies, though, likely benefiting from this. And south of the border, it's a similar situation. All the markets are off, but not too bad. In the pre-markets, they were off by more than 1%, many of them. But right now, the S&P 500 is down by 0.4%, the Dow by 0.5%, and the NASDAQ by about 0.4% as well. Defense companies doing well today. Airlines, travel industry, those ones are taking a hit. And let's see what oil is doing right now. It is up more than 6%, getting in above $71 a barrel right now. It's been surging the last little while, and then this today, of course, with the news out of Iran over the weekend. You can see where oil is going up. Also on the rise, or it was earlier, let's see where it is now, is gold. And it's still up. At one point, it was up close to 3% overnight, but now we're at 1.7%, back below 5,400. Earlier in the day, it was trading above 5,400. And how's our loonie doing today against the U.S. dollar, which people have been heading to as a safe haven? You can see the Canadian dollar's off against the U.S. dollar, down by 0.26%. People perceiving the U.S. dollar as a safe haven, much the same as gold right now. Coming up, we'll take a look at the pickup in volatility and what it means for long-term risk with David Rosenberg, President and Chief Economist and Strategist at Rosenberg Research and Associates. Well, the war in Iran is expanding. More casualties reported while Israel and the United States continue to pound Iranian targets. Iran and Iranian-backed militias have fired missiles at Israel and Arab states in retaliation. CTV's Adrian Gobriel is tracking the latest from Turkey.
Here in Istanbul, the war being waged in this region is being watched closely. Iran and Turkey share a land border more than 500 kilometers long, and the close proximity to the fighting is weighing heavily on the minds of many as the tentacles of this war begin to spread and take hold. This video shows a fighter jet in Kuwait falling from the sky. Officials in that country confirming that a number of U.S. fighter jets crashed, though all crew members have survived. U.S. Central Command say 3 of its F-15 jets flying in support of Operation Epic Fury, the U.S. operation in Iran, went down over Kuwait due to an apparent friendly fire incident. In Saudi Arabia, heavy smoke could be seen billowing from this oil refinery after an Iranian drone strike was reported there. Early this morning, a British Air Force base in Cyprus says it too was targeted by an Iranian drone attack. Meanwhile, Israel and U.S. forces are increasing their pressure on Iran and its proxies in the region. The Israeli military confirming they've taken aim at Hezbollah targets in Lebanon, where at least 31 people are said to have been killed after the IDF accused Hezbollah of firing rockets towards Israel. Now, inside Iran, Red Crescent workers say more than 500 people have been killed, including at least 153. That includes children who died here when a U.S.-Israeli attack hit this school. Meanwhile, President Trump is warning that attacks on Iran will continue until all of Washington's objectives are achieved, while promising to avenge the death of 3 American soldiers who died in combat. This is a conflict that is escalating. Many here are pondering what the days ahead may have in store. Adrian Gobriel, CTV News, Istanbul.
Well, markets are starting the week in the red as the geopolitical tensions ramp up with the latest escalation in the Middle East. The pickup in volatility has investors wondering what this means for long-term risk. All of this is putting even more attention on the Federal Reserve and the Bank of Canada as they weigh their next moves with rate cuts back on the table, but also maybe inflation a concern. For more on this, we're joined by David Rosenberg, President and Chief Economist and Strategist at Rosenberg Research and Associates. David, thanks very much for joining us.
Pleasure's mine.
You have to tread lightly at moments like this, don't you?
Well, I think that if you are a patient long-term investor, there's nothing that's happening here that should really alter your portfolios. I always say that it's a fool's errand to invest around geopolitics. You don't even have to go back and point to what happened in June of last year and that 2-week conflict with Iran, but just go back to 2022 when Putin invaded Ukraine, and this is the way the markets operate. They get jumpy, they overreact, and you get this huge risk-off trade. Usually at the onset of these geopolitical periods, the maximum move is usually at the very beginning. But nobody should be altering. I mean, if you want to trade around this, go right ahead. You want to turn bullish on the oil price because of all the concerns around the Strait of Hormuz and shutdowns of production facilities in the Gulf. To me, this is all going to be short-term in nature if you want to define short-term as, say, the next 2 to 4 weeks. So I mean, personally, I'm not changing anything in my asset mix because of this.
And so you think this could be resolved within the next month? Or not, I guess maybe resolve might not be the word, but the fears will ease within the next month.
Well, look, there's always tail risk. You can't ignore that. But that would be my expectation. Because the one thing that we do know is that after being totally decimated last summer, and Iran doesn't even have any control over its airwaves, tells me that this should be over. I mean, I know you have people out there saying that we're in some sort of multi-month or multi-year quagmire. There's no doubt that Iran can do damage through its ballistic missiles, but at some point its arsenal is going to wear out. The question is going to be, what's the resolve, not of the Israelis, what's the resolve of President Trump to see this through? So could it be more than a month? Sure. The Ukraine war has now been several years. Everybody thought that Vladimir Putin was going to walk all over Ukraine. But even though that's been several years going on as far as Russia-Ukraine is concerned, the question you would have to ask yourself is, would you have just moved all into cash or all into energy in the winter of 2022 because of what happened with Russia-Ukraine? The answer is that if that's what you did, moved into cash and energy stocks, well, you would have missed out on a whole lot of other things going on. So it could last longer than that, but so long as you're confident as what the end game is going to be, and if the end game is going to be regime change in Iran, then all you can really think about the longer term, even if it's more than a month, is what that's going to look like from, I'd say, a general global stability standpoint. So I'm not generally known to be Pollyannish, but I'm putting my positive hat on this one.
And are you looking anywhere for any opportunities? I mean, we saw travel and airlines taking a hit today. Where are you dabbling at all?
No, I'm not dabbling because my nature, I'm not a day trader. And if you are a day trader, then yes, that's what you'd be doing. I think that coming out of this, the areas that get hit the hardest, as you said, airlines, travel, accommodation, they'll bounce back. And they could bounce back from a lower level, but those would be your greatest opportunities. And to be making, bullish assessments of what oil's going to be doing, again, that's very short-term in nature, right? So many people were going bullish on energy in 2022, and it was a round trip in the oil price. You go back to the June of last year, the first day of that conflict between Israel and Iran, and of course the U.S. ultimately bombed Fordo. The oil price jumped 7% in day one. So you got to separate what's transitory and what could be a tradable opportunity. But I would agree with I would agree with your premise that if you have liquidity on hand and you're looking at the stocks that are getting pummeled the most, those will be the ones that'll snap back the most. Once the clouds part.
And what does the Bank of Canada and the Fed do with this? I mean, if oil prices drag on, that could put inflationary pressures on. Where do you see all that unfolding?
Well, it cuts both ways. Energy gives you headline inflation, true, but it's also a serious depressant on real incomes, and then that affects domestic demand. And so one hand washes the other. As far as the Bank of Canada is concerned, I don't know how you look at those GDP numbers that came out late last week, and you look at the fact that the economy is basically at best flatlining. I mean, we're going to do well just to have 1% GDP growth in the first quarter. The Bank of Canada's last estimate was 1.8%. And the inflationary pressure in the economy is clearly subsiding. This energy impact aside, I think that the Bank of Canada, their next move is going to be to cut rates. I don't think they should be sitting on the sidelines, in my opinion, based on what's happening with the output gap in this country, the excess capacity in the economy, this inflationary momentum from the spread between aggregate demand and aggregate supply. I know I'm sounding like a economics professor here. I don't know why they're staying on the sidelines as long as they are.
Okay.
The Bank of Canada, to me, is an easier call, notwithstanding the fact that rates have come down a lot. People talk about, well, look where the policy rate is at 2.25%, but nobody borrows at the policy rate. The banks do in the interbank market. Nobody borrows at that rate. The average interest rate for the typical Canadian is closer to 5%. And people still talk about, well, look what the Bank of Canada's done. The Bank of Canada has just been pushing on a string because market interest rates, the interest rate that matters for most Canadians, haven't gone down nearly as much as what the Bank of Canada has done with the overnight rate.
Okay.
As far as the Fed's concerned, they've been talking hawkishly. They convinced the markets that the first rate cut in the U.S. is not coming until we're well into the second half of the year. And this is all happening before the events over the weekend. So the Fed is probably on hold. I think they'll be cutting rates too, but that's being pushed further out. The Bank of Canada, I think, is on thinner ice with its decision to stay on the sidelines indefinitely.
Okay. We've got to wrap it up there, David, but thank you as always for joining us.
All the best.
David Rosenberg is president and chief economist and strategist at Rosenberg Research and Associates. Our Andrew Bell is at the PDAC Mineral Exploration and Mining Convention today, catching up with some of the sector's most influential voices. And let's go to him now. And he's standing by with the CEO of West Haven Gold and Dundee. Andrew.
Thanks very much, Roger. Yep, we're at PDAC, the world's greatest mining show. And of course, actually doing deals is one of the main reasons for this get-together. I've got two mining executives here who did a deal in December, since when the stock of one of them has shot up. So we're here with Ken Armstrong, who is the CEO of West Haven Gold. Great to have you here.
Thanks for having me.
And we've also got his partner, Jonathan Goodman, who is CEO of Dundee Corporation. Jonathan, great to see you.
Thanks. Good to see you too.
Great. Just bring your mic up a bit there, okay. Jonathan, and looking good. So let's just talk about this project, if that's okay. Sure. You're in southern BC. A lot of the buzz has been about the far more remote Golden Triangle. But you can actually, most of your focus right now is on a mine you'd like to build at Shovel Nose.
Yep. Yeah, it's southern BC. It's an area that everyone does know, the Golden Triangle. It's been a great sort of marketing position in northern BC. Yeah. But southern BC has just as good endowment in terms of mineral potential. There's operating copper mines. Teck and the Highland Valley copper mine is the largest copper mine in Canada, and it operates just right close to where our project is. We're a gold project. It's an epithermal gold-silver deposit that was found by West Haven about 6 or 7 years ago, and we got it to the point where we knew it was in a great location, excellent endowment. It's a 2.5-hour drive from downtown Vancouver on the Coquihalla Highway, so anyone who's driven the lower mainland into the interior has crossed our claims. And we were looking at what is the best way to advance this project and fund the work that needs to be done.
Let me grab the mic there, Ken. Jonathan, you were telling me something interesting. So when you did the deal with West Haven, you're spending up to $85 million to buy into, it's a joint venture essentially. So the problem, I'm sure Ken can tell us about this, but the problem for a company like West Haven, the market cap is only about 40 million. And they could raise money in dribs and drabs, but you just saw an opportunity to put more money and speed things up here.
You know, their market cap didn't really fully reflect what they had discovered. We see a very beautiful asset at Shovel Nose, and you're right. I mean, with a $40 million market cap, and the program gets to a point where you want to do the infill drilling, you want to advance that project closer to a mine, and we see that a lot in the capital markets of companies here. They wouldn't be able to raise the amount of money they need, so there was an opportunity to do a deal that was a win-win for both sides and could treat the project with the respect the project needs to get it to that point. a lot faster. And so for us, we're very excited about the deal, and it's a shared excitement on both sides.
Let me grab the mic. Ken, it's a pretty rich project in terms of grams per ton.
Yeah, the resource grade is just over 6 grams per ton, and then another 30 grams per ton silver. And top, that's a style of mineralization. I think it's an unusual or a more rare deposit type in Canada. We're used to more Archean type deposits. This is in a belt of rocks. The global comparison we'd look at would be Fruta del Norte and Lundin Gold. That's the style of deposit this is, and that's the upside potential that we saw, and that Dundee shared that vision.
And these are relatively young rocks. They're not that ancient shield stuff.
No, for Canada, they're 100 million years old, which is just yesterday for most of Canada, yeah.
Jonathan, just tell us a little bit about Dundee Corporation. We're here mostly to talk about Westhaven, but you've got quite the portfolio. You're in, what is it, a $400 million portfolio in various mining companies?
Well, it's about a $450 million portfolio. Plus we have close to $200 million in cash. And the portfolio invests in mining companies. We've got a very strong technical team, and we've all been doing this for a long time. And we kind of scan the rooms like this and find the ones that have been overlooked and unloved, and sign a CA and do the due diligence, and de-risk them and find groups that we can work with on great projects. And it's worked out very well for us.
Do you ever walk around to the two of you? You've been around for a while and see, oh, that's never going to work.
There's some that are more challenged than others, for sure, and that's what really differentiates this. We're with the agreement that we've done. Dundee will earn a 60% interest in the project. Westhaven will retain 40%, and we are together going to build a mine. It's not something where it's structured in a way where Dundee can tip their toe in and then out if they don't like it. They've done the due diligence, know that they like the asset, and they will have an interest in this project. So it's a proper partnership, and the market hasn't really seen well-structured option and JV agreements like this over the last 10 years. Often the major partner comes in and wants 75 or 80%, and it just doesn't leave any room for the junior partner. This is structured in a way that, as Jonathan said, it works for both companies, and we can now put the investment into the project and really give it the love that it deserves for moving it forward and getting it into production at a pace that we could not have financed on our own.
But it's still, Jonathan, it's mining. It's still going to take a few years before any gold comes out of this thing.
Well, of course. I mean, the reality of it is, the mining process is slower than we'd all like it to be. But, that's okay. We got to dot our I's, cross our T's. Too many mines start up in this country and don't work. So the fact that the process is slow gives us the time to do the homework, make sure it's completely de-risked, and make sure that we're not one of those.
Is that right? Mines are opened and they never really earn a return?
There are at $5,400 gold. That's probably not right. Yeah. But in other gold markets, we've seen that year in, year out, and that's always been one of my theses. As why are we making such big mistakes in this industry? And that's why the way we do it is we sign a CA, we do our own due diligence, so we can make sure that the way they've done their geology, the way they've done their resource calculations. And you learn. I always joke, you learn a lot about a company when you go into their data room, how they think and how they're organized. This one was awesome. Like our technical guys are usually complaining about the data rooms. On this one, they were just, wow, these guys have it right.
Ken, tell us about yourself. You're a geologist. In the past?
Well, I started my career with Kennecott and Rio Tinto at the Diavik mine, and that's when I met Ira Thomas, who's the chair of Westhaven, and Gren Thomas, who is the founder of Westhaven, along with Gareth Thomas, and have worked sort of within that group over my 30-year career as we get into that. So on the technical side, I love the technical aspects, and the real opportunity with this now is a chance to actually to build on the discovery that's been made and to get this mine into production, and there are more deposits like it to be found in this area.
Right. I mean, do you have the rights to all this stuff here?
Just the purple sort of areas are mineral claims, and then that golden area are the rocks that actually host the mineralization. And the endowment along that belt is over 100 kilometers of strike extent, and there are gold-bearing epithermal quartz veins all along it. It has just never had the opportunity to be marketed in a way. You mentioned the Golden Triangle, which has sort of that cross-pollination of many companies raising money, drill results, investors get to know the area. Yeah. Westhaven's had to kind of do the heavy lifting on this belt because it is a unique area, doing the drilling, and that's tough when you're doing it alone. And having Dundee as a partner with like-minded investors, we're able to do interviews like this, and so we're going to have a bit more help and profile as we go forward here.
Ken, thanks very much. Jonathan, close it off for us. You've been to a few PDAC shows over the years. What has changed, would you say?
Well, for one thing, everyone's smiling.
With the gold price?
With the gold price, it's a happier event these days. But, the PDAC, other than the fact that it's gotten bigger, has been very, they've always had this floor. I used to try and walk the floor at the beginning of every conference and just kind of, shake a lot of hands and see what people are doing and thinking, and you still can do it. It's the same structure, and it's just really bigger. It's a bigger deal, but it is the world's top conference, and it'd be nice to do it in June like we did in COVID.
That was a good one. Did you see watching baseball?
Yeah, I was cycling to work today, and or to the show, and it was a little cold. Yeah. Okay, so our guests have been Ken Armstrong, he's the CEO of Westhaven Gold, and Jonathan Goodman, and he is the CEO of Dundee Corporation. Thank you very much, gentlemen. Going to hand it back now to you, Roger.
All right, Andrew, thank you, and I know we'll be hearing from you all day from the show. And coming up, we'll bring you the latest headlines and update you on the markets, and we'll get the latest on OPEC planning a modest boost in production, even as the U.S. and Israeli war on Iran disrupts shipments. Shares of Cameco are trading higher after the Canadian energy firm signed a $2.6 billion deal with India to supply the country with uranium. It's up about 2.7% right now. Cameco will supply 11,000 tons of the reactor fuel starting in 2027 through 2035. The agreement follows Prime Minister Mark Carney's visit to India and reflects a reset in bilateral ties. Canada and India also agreed to cooperate in sectors including liquefied natural gas, critical minerals, and hydrogen. Shares of Hudbay Minerals are seeing a decline, 6.7% right now. The Toronto-based miner has signed a deal to acquire Arizona Sonoran Copper. The all-stock transaction is valued at about $1.5 billion US. We'll see Hudbay pay around $9.35 Canadian per share. Hudbay already owns a nearly 10% stake in the copper company. Deal brings its Cactus project together with its existing Arizona business, including its Copper World project. China has lowered its anti-dumping tariff rate on Canadian canola imports. The tariff was dropped to 5.9% from 76%. The move comes after the Chinese government dropped the original tariffs on Canadian canola products. Beijing said an investigation found that shipments were being dumped, causing material injury to the domestic industry. The levies will be in place for 5 years. And a quick look at the markets. And TSX been a bit of a turn after starting down. Of the concerns, obviously, about what is unfolding in Iran, but right now it's on the positive side, ever so slightly. And the S&P 500, it's down by about 0.45%. The market's reacting cautiously. And the NASDAQ is off by about 0.35. OPEC Plus agreed to boost oil output modestly, about 206,000 barrels per day for April. This came just as the U.S.-Israeli war on Iran and Tehran's retaliation disrupted oil flows from key members of the group. For more on this, we're joined now by Simon Casey, Managing Editor, Commodities and Energy Americas with Bloomberg. And thanks very much for joining us right now. It's what an interesting timing. They had their meeting on the weekend as this was unfolding. Casey, was that a factor at all? Was this something that was preset?
The meeting was already scheduled, and we'd assumed that there might be a production increase. Obviously, immediately preceding that meetings, hugely dramatic events, which changes the whole picture. So, as you say, it's a relatively modest increase. It does represent a sort of acceleration of production increases for OPEC and a resumption of production increases as well. But clearly, there's more that can be done. There's a lot of production capacity that's is still idled, and we will see how events progress from here, but it does give them the opportunity to increase production. But all eyes are really on the Strait of Hormuz right now, which, as you know, probably is 20% of the world's oil travels through that passage, and it's that route is to a large extent sort of shut down, not completely shut down, but there's very little traffic moving through there at the moment, and that is key.
And Simon, sorry, I called you Casey. My apologies, Simon. When does this rate become a real factor? It's already, I mean, it's a concern, obviously, but how long can they kind of let this go before it really starts putting pressure on?
It's probably a matter of days. You can already see oil prices are up. They were up as Brent crude was up as much as 14% overnight. It's a little lower now, but it's up still very much for the day. And prices will go sort of higher from there if that traffic remains largely halted. We have something like right now 40 tankers laden with oil sitting in the Persian Gulf waiting to transit. That's something like as much as 80 million barrels of oil stuck. So as the hours tick by, almost becomes more and more of a factor. Trying to work out exactly what happens from here is largely a matter of conjecture. It's not in the US or the rest of the world's interest, certainly, for that oil to be stuck. It's not in Iran's interest for that waterway to be halted for too long. It's certainly not in their economic interests, being such a big oil exporter in their own right. So, this is the key focus for the oil market right now. How long does that disruption continue?
And are there any alternate routes? Can it go by land to the north, or this is the only way that it's getting in and out of that area?
There is yes, you're right. There is pipeline capacity out of the Gulf, both to the Mediterranean and to the Red Sea. This does not make up or begin to make up for that 20% that I just mentioned. That huge amount of tanker traffic that ordinarily flows through there. So, if this route was shut in the long term, say for weeks, and it's still very much an edge case at this moment. But if that was the case, then we would be looking at much higher oil prices from here, and some of the more extravagant forecasts point to $100 per barrel plus in such a situation. But I must hint, there's no indication yet that this is a long-term plan. Mm-hmm. Nobody has indicated that that's the likeliest outcome at this point. We just don't know. It's still very uncertain.
And we're also natural gas too. We're seeing it was Norway was soaring. It was up 45% the price.
Yeah,
at one point.
That is, you could argue that today, actually, the biggest market impact really has been in the natural gas. Certainly, if you look at European futures prices, that, as you say, they're up more than 40% this morning. LNG, a huge amount of LNG flows through the Strait of Hormuz as well. Qatar Energy said earlier today that they shut down their production following an attack on one of their facilities. That creates real problems in Europe, which is very dependent on natural gas imports. It's a huge opportunity for US exporters. So shares of a couple of the listed US LNG producers were shooting higher this morning. So there's a massive upheaval there as well. Again, with the caveat, we just don't know how long this could all carry on, and it could possibly go back to normal within the space of a day or so. Maybe not.
All right, Simon, thank you very much for joining us today. We appreciate it. Simon Casey of Bloomberg. Shares of airlines, cruise operators, and hotels under pressure today as investors react to the conflict in the Middle East. For more on that, we're joined by Bloomberg's Matthew Griffin. And Matthew, thanks as always for joining us. Let's start first with somebody actually benefiting. Defense stocks are rising nicely today.
Yes, well, Roger, thank you for having me. And defense is one of the few areas of green on my screen today. You look at the so-called prime contractors, Lockheed Martin, RTX, Northrop Grumman, all advancing alongside some newer players. So a defense AI name, Palantir, drone maker AeroVironment, also staging rallies. The conflict in the Middle East is boosting the case, analysts say, for higher defense spending around the world. Truist says it could help build President Donald Trump's desire for $1.5 trillion in military spending by the United States for 2027. That's something the president has already talked about. And analysts at Jefferies told me that it could also cause the Middle East to want to get in on the spending boom around the world as the world gets more dangerous. And a lot of that money would also flow to U.S. weapons makers.
All right. Now, going the other way through all this, Travel's taking the biggest hit. We'll start with the airlines. How are they doing right now?
Yes, airlines are not having a good day. I was just looking at American and United down more than 4% each. This situation is really a triple whammy for airline stocks. For one thing, you just look at the jump in crude prices we're seeing today. Of course, you use oil to make jet fuel, and Jefferies says that every 5% move in their estimate for the price of jet fuel this year hits Americans' earnings per share by 35%. It's smaller for some other airlines, but still a really significant impact. And then you also think about what can happen to travel as a result of geopolitical conflict. The direct exposure to the Middle East of American carriers is lower, but a conflict can snarl travel around the globe. It can also just weigh on consumer sentiment, especially if higher oil translates into damage to the economy.
Yeah, and I mean, the big thing is people traveling for leisure and pleasure. Carnival Cruise Lines, I imagine people hesitant at this moment.
Yes, Carnival, last time I looked, down as much as 11% today. This, is really sucking some of the air out of the room. And these moves come even though traders were positioning for a conflict in recent weeks. The shares had been volatile across the travel sector and had already really started to slide on Friday when it looked like talks between the U.S. and Iran had ended without a breakthrough. You saw a basket of U.S. airline stocks actually fall the most since April on Friday, again, before the airstrikes even began.
All right, we'll wrap it up there. Matthew, thank you as always for joining us. Bloomberg's Matthew Griffin. Coming up, hot picks. We'll zero in on 3 plays in the industrial sector after this. Time now for hot picks, and we're zeroing in on 3 plays in the industrial sector. Our next guest has Secure Waste as his top pick. The leading waste management and energy infrastructure company operates primarily in North America, focusing on sustainable waste solutions and energy services. For more on this, I'm joined by Ian Gillies, Managing Director at Stifel. And Ian, thanks very much for joining us. Let's get right to it. Secure Waste is off the top. Number 1 for a reason, I guess?
Certainly. When you think about where we are in the stock market today, there's an elevated risk of concern in and around AI, disintermediation, how it's going to impact people-centric businesses and blue-collar or white-collar businesses, And we think Secure stands out from this pack because it has what is largely an irreplaceable network of assets in Western Canada that removes and helps clean up oil field waste. We think one of the interesting things about this stock in particular is that there's really only 2 players that do this in Western Canada. That creates a very strong operating environment for the company. And because of this, what you have is the ability to move prices up 3 to 5% every year, alongside the ability to benefit from higher waste volumes. Western Canada production grows at roughly 2 to 3% every year. And then the other important aspect for this business is that it's an integral player in water disposal and dealing with some of the ongoing water production in Western Canada. And so because of all of this, the company is growing its EBITDA at roughly 7% a year. But the more interesting thing for us is that the company converts roughly 50% of this EBITDA into free cash flow, and it doesn't need to invest a whole lot of capital back into the business. And so as a result, it's growing its dividend. It recently just started doing that again. It is able to buy back quite a bit of stock. We think they could buy back anywhere from 3 to 5% of their shares this year. And then it's also moving well through a consolidation strategy of rolling up metals or scrap steel businesses throughout Western Canada. And that's an important business because you're seeing a proliferation of electric arc furnaces being built in North America. And so the combination of these items lead us to believe we think investors are going to start moving back to old world businesses. And this is the one with all the financial characteristics you'd like to see.
And does it have any expansion plans right now? I mean, you say we just meant Western Canada, but is it looking beyond that outside of North America?
It's primarily a Western Canadian business. They're adding to their asset base in and throughout Western Canada. There's always small bolt-on projects. I believe there's been some looks at U.S. assets in the past, but it's a very different operating environment, and there's more than enough growth to be had in Canada at this time.
There is. So you do think there's room for it? Any challengers, or does this have a moat?
There's a very real moat. When you think about the facilities this company's built in Western Canada, the last one was built in 2014. Were costing, call it anywhere between around $35 million then. We think these facilities could cost anywhere from $50 to $75 million now. And we don't believe there's access to capital to build these, nor demand. So we don't believe that they can be replaced in any way, shape, or form.
Okay, let's get a couple more in here. Badger Infrastructure Solutions. They do the shovel-less digging, right?
Yeah, Badger's once again a pretty interesting business right now. They do non-destructive excavation. So if you were digging a hole in your backyard and you didn't want a line strike, these guys, their trucks would make sure that doesn't happen. Now, that's not what they do. The focus for Badger is largely on large industrial and commercial projects, and they're about 90% U.S. focused, and they're benefiting from a number of tailwinds in the U.S. Number one being an increase in infrastructure-related spending through the IIJA and the like, but there's also a very, very strong benefit coming from AI and data center development. This is about 8% of their business now. And when you think about the power and utility needs, with Badger being the largest hydrovac company in the US with a coast-to-coast network, they should very clearly be a winner. One of the interesting things for me about this stock over the last month or so is that it has traded off around concerns in the first half of the year that margins won't be going quite as fast. But we think people are looking at this the wrong way. They're investing in their business through the next few quarters because they see a rapid growth wedge coming in the back half of next year and into 2027. We think we're going to get verification of this later this week through a higher truck build program than the market's expecting. And we think this one's going to be a real winner when we look out 12 months from now.
Okay, and last but not least, WSP.
Yeah, WSP has been a very interesting stock this year. It has suffered at the hands of this AI disintermediation trade. We believe the baby's been thrown out with the bathwater on this stock in particular. When you think about engineering, it is drastically different than something like software. And because engineers tend to operate in the real world, we actually thought the CEO of WSP made a very interesting point last week on their conference call, and that engineers are deterministic rather than probabilistic like AI. And when you think about that, as you're building bridges, looking at soil, doing the things we use every day, you need a determinate answer and not the best probability, because we can't have these assets fail. It's going to take some time for the market to sort out the wheat from the chaff related to these businesses, but we do believe that the company's long-term consolidation story, the spending trends we're seeing out of governments globally, are going to continue to drive solid fundamentals. And so with the stock trading at, call it roughly 18 times earnings right now, we don't think you get very many chances to buy businesses of this quality at this sort of multiple.
Okay, we'll wrap it up there, Ian, but thank you as always for joining us.
Thank you.
Ian Gillies is Managing Director at Stifel. Coming up, we'll do a final check on the markets and bring you some of the biggest movers in Toronto today. China has suspended some agricultural tariffs on Canada. CTV's Alex Karpa has more on the impact this could have on farmers who are feeling a sense of optimism ahead of the start of seeding.
So, potential home out here for a bunch of yellow flowers this summer?
Curtis McRae is thinking about the upcoming farming season. His plans to grow around 2,000 acres of canola this year.
I'm holding the number very close to the same as last year, hoping for markets to rebound.
But last year was anything but easy. Punishing tariffs imposed by China on Canadian canola took a significant toll on farmers like McRae.
I'm out of pocket a bunch of money from last year. It took $1 billion out of family farms' pockets. And I don't think there's anybody thinking about replacing that.
As of Sunday, the 100% tariff on canola meal and peas and a 25% levy on lobsters and crabs won't be imposed by China any longer, a reprieve that will continue through to the end of 2026.
Initial reaction is optimistic because seeding's coming up soon, and hopefully I've made the right cropping decisions.
Prime Minister Mark Carney met earlier this year with Chinese President Xi Jinping, and the leaders inked a deal on electric vehicles and canola. Farmer Warren Ellis calls it progress, but says more needs to be done.
Better, but not the whole answer. I mean, it's better. It will allow some through, but there needs to be a lot of work done yet on that.
An economist says the suspension of some canola and seafood tariffs between Canada and China is a win-win for both parties, but says the duties could be reinstated if the relationship deteriorates again.
Diversifying our relationships, both economic and political, has advantages and disadvantages. In this case, the advantage is that we should be able to sell more canola and grain and other agricultural products. But the disadvantage is we no longer can depend on a reliable American partner to protect us.
As for McRae, he says he's looking for stronger support from Ottawa to help ensure family farms can weather future trade disruptions and remain sustainable for years to come. Alex Carper, CTV News, Winnipeg.
All right, let's see how the TSX is doing today after the weekend that was. It's pretty much a wash right now. It started off in the red, but it's up ever so slightly. Really not worth mentioning, 0.01%. In the TSX. Looking at some of the winners and movers right now, and let's bring up energy fuels, and it is up 7.4%, almost 7.7% right now. This after it reported it widened its net loss year over year for the full year for 2025. That was last week that it announced it. Vermilion Energy also seeing a nice boost, of course, on all the fears that are unfolding right now. It has its earnings Q4 coming out later this week. And another one doing all right based on the natural gas unfolding. The price is soaring for natural gas. Methanex is up 3 3/4% right now on the fears in the Middle East, and that has their volume jumping. It's more than 5 times their 20-day average right now. Now, going the other way, Endeavour Silver is taking a bit of a hit today. It's off by about 6.6%, and it's really no real reasons for it. Just silver was rising today, but it's silver struggling. Hudbay, though, off by 4.22% right now. This following the announcement that it was buying the Arizona Sonora Copper in a $1.48 billion all-stock deal, $9.35 Canadian per share for this, and that would help strengthen their whole assets in the Arizona area. It's a premier America-focused copper company with this transaction. They're saying together it brings together their two highly complementary copper growth assets there. And Air Canada, another one, taking a hit today. It's off more than 6%, and that is, of course, over the Middle East and what is unfolding there. Fears of soaring oil prices. Fuel is such a key factor for the airlines. Loss of travel as people hesitate going anywhere, and that could linger for a while. And also just the added expense anywhere they fly in the Middle East, if they have to fly around all those no-go regions around Iran. Most of the countries around there are not flying right now over the fears of possible errant missiles hitting airplanes. And so for now, a lot of the airlines taking a hit today. Air Canada is not the only one. Look south of the border. It is a similar situation. Berkshire Hathaway shares are down and leading losses among a gauge of financial stocks after the conglomerate's operating profits fell nearly 30% in Warren Buffett's last quarter as CEO. Analysts are highlighting the weakness of the company's insurance businesses. Quick look. I think it's it. Gold's up. Oil is up as well. And we're up. Time is up now for the open. Morning markets are up next.